Well, something that a lot of us or the market or even mainstream media tend not to share with the broader audience is the fact that some of the biggest hedge funds year to date since since 2022 started are really in a bad shape. Maybe worse shape, worse than what they want us to believe. And I'm going to share with you an example here with another, hedge fund we've been talking about quite some time now. It's not Citadel, it's not Citadel, but it's somebody else. But by looking deeper into this, the reality of the performance so far, you cannot help but be very bullish, especially as the momentum is coming back into what they call the meme stocks. All right, so let's get into it without further ado. So I'm going to share with you this article from it's with a Bloomberg or Yahoo Finance on Tiger Global's hedge funds. As you can see on their headlines here, it sinks 34% this year as key stocks fall. Highlight the key stocks part because this is something I've been sharing with you for the last 3 to 6 months, and now given where the market is actually looking as the next direction to go, it might be worse for them. And when it's worse for them, on the other side, it's good if you hold a stock like AMC. Why? Look here. Things have gone from bad to worse at Tiger Global Management's flagship hedge fund, all right? So the vehicle fell nearly 34% the first quarter due to poor performing stocks and markdowns on private holdings, according to an investor letter seen by Bloomberg. The hedge fund tumbled more than 13% in March. That is March only. All right. According to a person familiar with the matter, capping 3 straight losing months on a tough 2021. 3 straight losing months on a tough 2021. I think they meant to say 2022. The decline was 7% last year. All right. It was even declining 7% last year, and it was the first annual drop since 2016. Stocks declines in our focus areas have been steeper, faster, and longer lasting than in prior drawdowns, the firm said, signed by the investing team in a letter that they sent out. While Tiger Global short generated gains, they have not really kept pace with the decline in the longs. All right. So let me pause here for a second. What is happening here is since 2016, 2021 was really the first time they were having a tough time. Why? Because the hedge funds literally are these folks that whenever they move in the market, they move big, all right? And they move in something they have high conviction, meaning it's pretty much sure, 100%, sometimes 150% sure that whenever they're buying or selling, will return them a big amount of money. But in 2021, the market was not following along with them because they were not, the stocks that they picked were not performing well, even though they were short in the market, all right? But now the market is not really doing what it was doing back in 2020 and 2021. And what the stocks they were holding in high convictions, like the Microsoft, you're going to mention that at the later part of the article, those stocks have been losing a lot of the price have been going down 50%. And this is mostly the high stocks, the tech stocks, all right? Now, what happens is, even though they are still shorting a stock like AMC, the fact that money is going to be more expensive, holding debt is going to be more expensive because these guys also trade and have the strategies using a lot of credit, a lot of, margins, all right? It's going to be more expensive for them to sustain those high, short positions, all right? But in the meantime, it doesn't help them as well if those positions where they were long, the positions on the stocks like the Microsoft or the NEO or the Lucids or the Teslas have been dropping so far. Maybe not the EV so far lately, but you get the idea, right? You get the idea that at some point, the pressure is going to be very high. And this is precisely what we're seeing so far. Now, what is really more interesting into this is as we get into 2022, nobody really knows how the Federal Reserve is going to address the interest rate, with inflation. They might say we're going to stay on course, and if they do, well, maybe we're not going to see a dramatic punch into the tech stocks, all right? Now, on the other hand, if inflation remains really high, especially with food costs, especially with energy prices remaining high, which I think is going to be the case, especially with the conflict in Russia, well, it means that at some point the Federal Reserve can say we need to increase interest rate by 1%. That 1% drop in some of these positions, it's so much money that they need to come up with that is already in a market where money is getting rare, liquidity is drying up, all right? So that put them in a situation where at some point they will have to cut off some of these positions that are making them lose the most amount of money. And I bet you that is not going to be the stocks in which they are long, the stocks they are buying, but these are going to be the stocks they shorted so far and are causing them to have to pay the most amount of money in terms of fees to maintain those short positions in a monthly or even in a daily basis. So the bottom line is, as we get into this, whether there is going to be a recession or not, if you add to everything I just said and share with you, if you add the fact that in these type of market conditions, people look for stocks that are going to produce a lot more of passive income, dividend paying, high dividend paying, or what we call the value stocks, stocks that are now being undervalued because so many other hedge funds, so many other big investors were chasing high growth, the tech stocks. But now in these current market conditions, it doesn't make sense by doing the math to be so far invested in those stocks. All right. So it's going to be a rotation that we already see starting, and that rotation means money is going to flow out again in these stocks that they are holding. So as you can see, the bottom line is things are not looking good for the hedge funds. And I don't know why people are not really addressing this as much as they should, but the reality is this is not the case. This is the case not only for this Tiger Global Fund, but also for a bunch of others. Not only hedge funds in reality, but also smaller companies, smaller funds that came into AMC when the price was maybe at 35 or 50 or 40. Those are going to be the ones to feel the pressure the first. And as soon as they get out, we're going to see exactly what we saw these couple of days, all right? These past 10 days, these past 14 days. Meaning they're going to start covering, and as soon as they start covering, the price gets higher. But because conditions are steeper, conditions are tighter, it's going to take a lot more for them to bring the price down further and as much as they are willing to, hence causing other investors to get in and to get in and to get in, especially with what AMC is doing on the back on the fundamental side of things. Transforming the whole company, which is very, very bullish. So again, very, very strong sign that, hey, you want to stay invested into AMC if you want to see where this thing goes. This is kind of what I am doing, but feel free to do whatever you want with your money. It's your loss, it's your gain, you choose.